This is Capital Clarity, a channel where we explain how money works clearly, simply, honestly. And today we are going to explore one of the most misunderstood yet most important topics in modern economics. A topic that most people were never taught in school, but one that directly affects their savings, their loans, the prices they see in stores, and their financial future. Today, we are talking about how money is actually created. Most people believe that money is created when governments print it. That somewhere there is a printing press that gets turned on during difficult times, and that this is when new money enters the economy. This idea feels logical because we can physically see banknotes, we hear about money printing, and we naturally associate money with paper. But in reality, modern money is almost never created by printing cash. Today, more than 90% of all money exists not as physical cash, but as numbers in bank accounts. These are not banknotes stored in vaults or coins carried in wallets. They are digital records inside banking systems. And it is this digital money that shapes the economy, drives inflation, determines asset prices, and creates financial cycles. To understand how money is created today, we need to completely rethink the role of banks. Banks do not simply store people's money, and they do not merely transfer savings from one person to another in the form of loans. In a modern financial system, banks perform a much more powerful function. They create new money. When a person goes to a bank and takes out a loan, whether for a home, a car, or a business, the bank does not search for that money in a vault. It does not take deposits from other customers and hand them over to the borrower. Instead, the bank simply creates a new entry in the customer's account. That entry is new money that did not exist in the economy before. At the moment a loan is issued, the bank creates two financial claims at the same time. The first is the borrower's debt to the bank. The second is the borrower's deposit, the money it can now spend. And at that exact moment, a total amount of money in the economy increases. This is a crucial point that is often ignored or poorly explained. Money is not created when it is printed. Money is created when someone goes into debt. Almost every new dollar, euro, or unit of digital currency has a mirror image on the other side of the balance sheet. A debt. This system did not emerge by accident. It was designed to allow the economy to grow. Without credit, a modern economy would be almost impossible. Businesses would struggle to expand, people would not be able to buy homes, and governments would be unable to fund infrastructure. But alongside growth, this system also creates risk. Because if money is created through debt, then debt must keep increasing for the economy to keep moving forward. And over time, this can lead to a situation where debt grows faster than real income. Central banks play a unique role in this system. They do not create most money directly, but they control the conditions under which commercial banks can do so. Their primary tool is the interest rate. When interest rates are low, borrowing becomes cheap, and banks are more willing to create new loans and therefore new money. When rates are high, borrowing becomes expensive, and money creation slows down. In this way, central banks do not directly control the quantity of money. They control the incentive to take on debt. And through that, they influence inflation, housing markets, stock markets, and overall economic activity. The problem is that the system is extremely difficult for the average person to understand. Most people only see the outcomes: rising prices, cheap credit, financial crises. But they do not see the mechanism behind them. When an economy grows too fast, banks create too much money. That money starts pushing prices upward. Real estate becomes more expensive, stocks rise, and assets become less affordable. It looks like wealth, but often it is just an illusion built on debt. When the system becomes overloaded and debts grow too large, the process reverses. People stop taking loans. Banks become more cautious. New money stops being created, and the economy begins to slow down or even contract. This is how financial crises are born. Not because money disappears, but because money creation suddenly collapses. When debt stops growing, money effectively vanishes from the economy as loans are repaid. When a loan is repaid, the opposite process takes place. The money that was created alongside that loan is destroyed. It disappears from the system. What remains is only the interest, which becomes the bank's profit. This means the system constantly requires new loans to remain stable. Without them, the economy shrinks. That is why governments, banks, and central banks are so afraid of a credit slowdown. From this perspective, it becomes clear why inflation is a constant feature of modern economies. When the money supply grows faster than the production of goods and services, prices rise. This is not an accident. It is a direct consequence of how money is created. For ordinary people, this has very real consequences. Money sitting in a bank account slowly loses purchasing power over time. Savings without investment gradually erode, and financial literacy becomes not a luxury, but a necessity. Understanding that money is created through debt changes the way we look at credit. Credit is not just a convenience. It is a core part of the system that shapes the economy. And every decision to take on debt carries long-term consequences. It also changes how we view government finances. Government debt is not the same as household debt, but it is still a mechanism for creating money. When governments borrow, they influence the money supply and economic cycles. Modern money is not something physical. It is a system of trust. Trust in banks. Trust in governments. Trust in central banks. As long as that trust exists, the system functions. When it breaks, crises emerge. That is why understanding how this system works is so important. Not to create fear, but to make better financial decisions, to understand risk, and to avoid living under financial illusions. Money does not simply appear out of thin air. It is created through debt, and every new unit of money carries an obligation with it. This is the foundation of the modern financial system. On Capital Clarity, we will continue to break down these mechanisms. Clearly, simply, honestly, because financial clarity is the first step toward financial freedom.